McGraw-Hill Audio presents The Successful Investor, What 80 Million People Need to Know to Invest Profitably and Avoid Big Losses. Written by William J. O'Neill. Read by Alan Sklar. Introduction. Why this book now? If you're a stock or mutual fund investor, you probably already know the answer. Chances are you're one of the 80 million Americans who lost 50 to 80% of your hard-earned life savings in the market decline that began in the spring of 2000. And you never, ever want that to happen again. But unless you make it a point to learn what happened to you, what went wrong, and why, there's no guarantee that history won't repeat itself. The purpose of this audiobook is to help you see some of the mistakes you made, and could make again, unless you adopt sound rules and principles to guide your future investment decisions. Only then will you be on the road to the kind of investment results that can and will materially improve your life. And if you're a new investor, you certainly want to learn what not to do, as well as what to do to become a successful investor. But, you say, wasn't the recent market debacle a once-in-a-lifetime event? Well, yes and no. The market bubble that formed in the anything-goes 1990s and blew up in the early 2000s was unusual. We hadn't seen anything like it in 70 years. But it was different only in degree. If measured by the NASDAQ, home to most of the high-tech stocks that got so inflated, the 1990s market went up even more than the superheated bull run of the Roaring '20s. And the losses that followed rivaled those suffered in the crash of 1929 that led to the Great Depression. The wild market of the 1990s can even be equated with the tulip bulb mania of 1636. Everyone then believed the whole world would have to buy tulip bulbs from Holland. As a result, prices of bulbs traded on the Dutch Stock Exchange reached astronomical heights before they came crashing down to earth. It was much the same with the Internet craze of the 1990s, when investors had to own a piece of every company with .com attached to its name. Otherwise, the latest market cycle was much like all those that preceded it. I know. I've been in the market day in and day out through every bull and bear cycle for the last 45 years, both as an individual investor and as an advisor to many of the best investment managers in the country. Moreover, as the head of a top database research firm, I've also conducted one of the most definitive studies ever done of the market and the stocks that always lead it. What impresses me most, even after going through a period like 1998 to 2002, is how little things change. The losses suffered in the most recent decline may have been extraordinary, but the mistakes that led to them were not. They were the same mistakes investors have made in every cycle. When you think about it, the reason for this becomes obvious. The market is made up of millions of people acting almost 100% on human emotion and personal opinion. It is crowd psychology on daily display, and especially when it comes to the hopes and fears and pride and ego that drive so many investment decisions. Human nature is pretty much the same now as it was in 1929 or 1636. What you must understand, though, is that highly successful investing has nothing to do with your emotions or personal opinions. The stock market doesn't care who we as individuals are, what we think, or how we feel. It's a beast like no other, indifferent to human desires, oblivious to common wisdom, maddeningly contrary, and seemingly bent on confounding the majority at every turn. The only law it obeys is the law of supply and demand. And until you, as an investor, come to grips with this reality and learn to move with the market rather than against it, you'll be plagued by results that are mediocre at best. This would be a shame, considering that Americans are taking more responsibility for their financial well-being. It won't be long, for example, until the Social Security system will be at least partially privatized. Then you'll be able to take some of the money that the government sets aside for your later years, and has invested for a pathetic return, and invest it yourself. Deferring to the market's opinion instead of your own won't be easy. And the smarter you are, the more difficult it may be. You may be highly educated with advanced degrees and accomplished in your own line of work. You may in fact be an expert whose opinion on the things you know most about usually goes unchallenged. But that can make it hard for you to see or admit it when you're wrong on an investment decision into which you put so much time, thought, and ego. In the market, who you are and what you think mean nothing. Repeat, nothing. The market's going to do whatever it's going to do, and arguing with it can only cost you money. Some of the biggest mistakes I saw in the 1998 to 2002 market were made by some of the smartest people I've met. I remember a Ph.D. with a high-level management position telling me he bought Cisco Systems, one of the best-performing stocks of the 1990s, when it dropped to $50 because it was such a great company. I just hope he swallowed his pride of opinion and got out before the great company got down to $8. Nor are professional investors immune from making amateurish mistakes. A bond fund manager I know bought WorldCom at $1.50, believing it simply couldn't get any cheaper after falling all the way from $64. Well, it could and did, changing hands at 17 cents the last time I looked. Most people, both investors and advisors, got hurt in the 2000 to 2002 downturn because they never took the time to learn sound investment rules and principles. In the 90s, they thought they'd found a way to make money without doing much homework. They just bought tips, touts, and stories. They didn't grasp the realities of market risk or how to guard against major losses. They didn't have a way of telling if the market was headed up or turning down, and worst of all, they didn't have any sell rules. But what the heck, life was good and everything seemed so easy. We got careless and carried away. Even some corporate leaders thought it was okay to lie, cheat, and exaggerate. After all, the leader of the country did, and it didn't seem to hurt him. In the stock market, all you had to do was buy high techs on every dip, because they always came back and increased in price. Opinions, however naive, were plentiful. So were experts, most of whom kept popping up on all-day TV market shows, telling us what to buy. Friends, neighbors, advisors, salespeople, all stood ready to offer their own advice, whether we wanted it or not, and all seemed able to back it up with investment theories, however flaky. For many, playing the market got to be just that, a sport or national pastime in which nearly everyone participated. At the gym where I work out, I remember a couple of fellows pooh-poohing Yahoo, the internet search engine, when it was in the early stages of its 100-fold move. A couple of years later, I overheard two others pumping iron and proclaiming all you needed to do to make a lot of money was buy Yahoo every time it corrected or pulled back in price. It was apparent to me that they had missed Yahoo on most of its way up in the late 1990s. Now it had become an obvious sure thing to the crowd at the gym. The stock plunged from $250 a share in January 2000 to $8 by September 2001. The guys at the gym don't talk much about the market anymore. When the bubble burst in March 2000, hardly anyone, except Investors Business Daily, the national financial newspaper we started in 1984, gave consistent sell advice or repeated warnings to reduce exposure and raise cash. Investors were left to learn the hard way a basic market truth. Personal opinions, feelings, hopes, and beliefs about the stock market are usually wrong and often dangerous. Facts and markets, on the other hand, are seldom wrong. The law of supply and demand works better than all the opinions of all the analysts on Wall Street or off. Most investors now realize they need to know much more about what they're doing when they invest their hard-earned money. They know they need sound, time-tested rules and procedures to make real profits, while at the same time protecting themselves from serious losses. Isn't it about time you got serious about your money and investments by reading, learning, reevaluating, and significantly improving your methods? When I started investing, I made most of the same mistakes you've probably made. I know how bad habits are formed and how hard it is to break them. But break them you must, so you can develop new habits based on how the market actually works. These new habits may seem strange at first. They'll force you to do things that you and most people don't like to do, are not used to doing, or never understood you should do. But they will, if correctly applied over time, produce a dramatic improvement in your investment performance. For example, you buy stocks on the way up in price, not on the way down. And when you buy more, you do it after the stock has risen from your purchase price, not after it's fallen below it. You buy stocks nearer their highs for the year, not when they've sunk so low they look cheap. You buy higher price stocks rather than the lowest price stocks. You learn to always sell stocks quickly when you have a small loss, rather than waiting and hoping they'll come back. You pay far less attention to a company's book value, dividends, or P/E ratio, which for the last 50 years have had little predictive value in spotting America's most successful companies, and focus instead on more important proven factors, such as profit growth, price and volume action, and if the company is the #1 profit leader in its field. You don't subscribe to a bunch of market newsletters or advisory services, and you don't let yourself be influenced by recommendations from analysts who, again, are just expressing personal opinions that can be frequently wrong. You also have to acquaint yourself with charts, an invaluable tool that most professionals wouldn't do without, but that amateurs tend to dismiss as complicated or irrelevant. To significantly improve my own investment results, I did 3 things. First, I studied only what the very best people with the very best performance records did in their own market decision-making. These include Jack Dreyfus of the mutual fund organization that bears his name in the late 1950s, Fidelity Investments' Ned Johnson and Jerry Tsai in the early 1960s, Gerald Loeb, a stockbroker and author of The Battle for Investment Survival, who made money from the 1920s through the 1960s. All these professionals produced far superior results at certain periods in their careers. Second, after I made mistakes and lost money or gave back most of my profits, I plotted on weekly charts exactly where I had bought and sold each stock. I analyzed what I did wrong when I lost money or blew a great opportunity. Then I designed and wrote down new rules that I carefully followed to prevent the same mistakes from happening again. These rules were written on 1 or 2 pages at the front of a little zipper notebook I kept with me every market day. Third, I cut out and collected about 50 charts of the top-performing stocks from several prior years. I wanted to know how they looked both fundamentally, earnings growth, etc., and technically, price and volume action, before they doubled or tripled in price. I then noted what key characteristics they all had in common, so I knew what factors to look for in the future. How well has all of this worked out? What kind of actual result has it produced? From 1998 through 2002, the American Association of Individual Investors, AAII, conducted its own real-time month-to-month study and analysis of our system, which we call CanSlim Investment Research Tools. AAII, a Chicago-based organization, compared the results of our system and rules, as defined and explained in my earlier book, How to Make Money in Stocks, with the performance of 52 other widely known investment systems, including those of Peter Lynch and Warren Buffett. According to AAII's April 2003 journal, quote, AAII has been testing the performance of a wide range of screening systems for over 5 years, and our interpretation of the CanSlim approach has been one of the most consistent and strongest performing screens during both bull and bear markets. Unquote. AAII's independent research results found CanSlim's performance to be as follows. 1998, plus 28.2%. 1999, plus 36.6%. 2000, plus 38.0%. 2001, plus 54.4%. 2002, plus 20.7%, for a total 5-year compounded return of plus 350.3% during 2 bull market up years and 3 extremely difficult bear market down years. Over the same 5-year period, the S&P 500 was down 8.3%. Out of approximately 10,000 equities screened by AAII on March 14, 2003, according to our rules, only 4 stocks survived AAII's screening. They were Apollo, $47.84, which by June 30th closed at $61.80. FTI Consulting, $28.30, closing June at $24.97. International Game Technology, $78.01, closing June at $102.33. And Teva Pharmaceutical, $38.10, closing June at $56.90. The average increase was 24.5%. During the 1980s and 1990s, thousands of dedicated, motivated subscribers to Investors Business Daily, who studied and applied all our rules and methods, made net gains of several 100% to 1,000% or more. Many joined the ranks of millionaires. Not everyone, of course, found it easy to cut all losses quickly, as we preached repeatedly, or to follow our rules on when to sell and nail down worthwhile gains. Just skimming our material, or not executing with real discipline and determination, or not understanding the rules of how to recognize a market top, assuredly produced a much more disappointing result. Our internal money management group, operating from our data analysis holding company, produced a 1,356% net return in the 5-year period ending June 2003. Readers who closely followed and understood the daily factual analysis of general market action in IBD's Big Picture column, as well as the hundreds of educational articles in Investor's Corner, sold stocks and raised cash in March and April of 2000. An even longer period of real-time performance applying our CAN-SLIM investment system is the New Stock Market Ideas, NSMI book, published weekly for institutional investors by our sister firm, William O'Neill & Company, since 1977. From that time to the end of 2002, the NSMI service chalked up a total return of 26,173%. Compounding results each year makes such a mind-boggling result possible. It was over 6 times the result achieved during the same time period by Value Line's excellent performing #1 ranked stocks, and compared to a gain in the S&P 500 of 909%. The real secret to why our system has worked so well for thousands of serious, dedicated investors is that it's not based on my personal views, beliefs, or opinions. CAN-SLIM is based 100% on the facts learned from our comprehensive study of every outstanding stock performer each year for the past half-century. All the traits they shared prior to their periods of greatest performance became our buy rules, and how the variables changed when each big leader finally topped became our sell rules. So when you violate any of the rules and principles we will disclose to you in this audiobook, you will probably make many more unwanted mistakes. You will be arguing with how the stock market has in reality worked for many, many years. Added to our meticulous analysis of historical models is years of experience working with and providing research ideas to many of the best institutional investors in the U.S. We built the first daily historical stock market database in 1963, And today, William O'Neill and Company has more than 600 of the world's largest institutional investors as regular clients of our computerized research. We had none of the problems faced by some Wall Street firms in 2002 because our business is completely different and independent. We publish no fundamental analyst research reports or recommendations, do no investment banking, make no markets in securities, have no retail sales staff or retail branch offices dealing with the public, and do not deal in bonds, commodities, or currencies. We only do a highly specialized institutional business utilizing our own sophisticated and advanced historical computer database. In this short audiobook, I've boiled down the age-old secrets of how you can become the successful investor to just 5 simple steps. If you have the desire and determination to listen and re-listen to these steps many times until you become skillful in understanding and applying each of them, your investment results should improve to the point you'll be able to afford a much better life and more of the things you want. It doesn't take a lot of money or an Ivy League education. Anyone can do it. You can do it. So go for it. It's all up to you. A word about charts. A picture, they say, is worth 1,000 words, but to the successful investor, a picture in the form of a stock chart is worth a lot more. And not just in words. Like the X-rays used by doctors, charts tell you at a knowledgeable glance if an individual stock, or the stock market in general, is healthy or sick. In so doing, they let you know if you should be in or out of the stock, or in or out of the market. And that, as you will see, makes all the difference. If you're not familiar with charts, or think they're too technical, don't worry. You were probably afraid of the water the first time you were taken to a swimming pool. But given a little time, and perhaps a few swimming lessons, they couldn't get you out of the pool. You might not take to charts with the same alacrity, but you'll find that with a little effort, understanding the patterns that charts sketch out will dramatically improve your future investment results. The more time you spend with charts, moreover, the more skilled you'll become. You will not only be able to recognize patterns that presage enormous stock moves, you'll also be able to detect patterns that are absolutely defective and must be avoided. This is of enormous value in helping cut down on your costly mistakes. Many cynics, because of their lack of knowledge, put chart reading in the same category as reading tea leaves. But they haven't stopped to think how professionals in most walks of life use charts to make better decisions. No doctor, for example, would feel confident in making a diagnosis of your physical condition without that X-ray or EKG or MRI. Professionals in the world of investing use charts the same way. And the most successful ones would no more buy or sell a stock before looking at its chart than a doctor would treat you without looking at the images he or she has to work with. Step 1. Which way is the general market going? Why start here, with directions on how to tell if the stock market as a whole is going up or coming down? Because when the general market, as defined by the S&P 500 index, the NASDAQ Composite Index, and the Dow Jones Industrial Average, tops and turns down 3 out of 4 of your stocks, regardless of their quality or how they're performing, will go down too. Besides, if you learn to recognize when the market is topping, you'll have a skill that very few investors have developed, and that includes pros on Wall Street. As a group, they failed to tell their customers to sell stock and raise cash in 2000 when the whole market was topping and 98% of all individual investors got hurt. What did the brokers, strategists, and economists do wrong? They relied purely on their own opinions of what the market would do. They also relied too much on their interpretation of the dozens of business and economic indicators they favor. This approach rarely, if ever, works, because the economy does not lead the market. The market leads the economy. That's why wiser souls years ago included the S&P 500 index, a proxy for the general market, as one of the leading economic indicators released by the government each month, and not a coincidental or lagging indicator. In short, the experts on Wall Street, by using the economy as a predictor of the stock market rather than vice versa, had it all backward. Another group of experts, called market technicians, follows 50 to 100 technical indicators such as advanced decline lines, sentiment gauges, and overbought-oversold measures. But in 45 years, I can't recall a technician picking both a market top and the eventual market bottom. At best, they're usually right one time and wrong the next. The reason is that the vast array of technical indicators they follow are secondary and far less accurate than the general market averages. There's an important lesson here. To be highly accurate in any pursuit, you must carefully observe and analyze the object itself. If you want to know about tigers, watch tigers, not the weather, not the vegetation, not the other animals on the mountain. Years ago, when Lou Brock set his mind to breaking baseball's stolen base record, he had all the big league pitchers photographed with high-speed film from the seats behind first base. Then he studied the film to learn what part of each pitcher's body moved first when he threw to first base. The pitcher was the object Brock was trying to beat, so it was the pitchers themselves he studied in great detail. In the 2003 Super Bowl, the Tampa Bay Buccaneers were able to intercept 5 Oakland Raider passes by first studying and then concentrating on the eye movements and body language of Oakland's quarterback. They read where he was going to throw. Christopher Columbus didn't accept the conventional wisdom about the earth being flat, because he himself had observed ships at sea disappearing over the horizon in a way that told him otherwise. The government uses wiretaps, spy planes, unmanned drones, and satellite photos to observe and analyze the objects that could threaten our security. That's how we discovered Soviet missiles in Cuba. It's the same with the stock market. To know which way it's going, you must observe and analyze the major general market indexes daily. Don't ever ask anyone, "What do you think the market's going to do?" Learn to accurately read what the market is actually doing daily as it is doing it. When the market is in an uptrend, advancing day by day, week by week, you want to follow not only the price action of the market averages each day, but more importantly, the daily volume. What you're observing is whether the total trading volume has increased or decreased from the day before. You're also taking note of whether that day's volume is above or below the recent average daily volume. What you want to see in an uptrending market is prices and trading volume rising in tandem for the most part. That shows a market under accumulation, with more buying than selling. The easiest way to track this action is with the use of charts that show the high, low, and closing prices of the various indexes with volume plotted underneath. A proper chart will have the volume close enough to the price so you can easily move your eyes from one to the other, connecting the right day's price with the right day's volume. In any uptrend, there will come a point when selling activity overtakes buying. This we call distribution, and it's important that you recognize it as it's happening. The first day of distribution is when the index closes down from the day before, but on volume that is higher. No uptrending market, however, is turned down by just one day of increased volume selling. What we've found by studying every market top going back 50 years is that 3 to 5 days, in recent years it's been 5 days, of volume distribution over a span of 2 to 4 weeks is sufficient to turn the market's uptrend into a downtrend. What you're watching for, then, after an initial day of distribution, is a second, then a third, fourth, and fifth. After the first day, the market may go up for 2 or 3 days before you see a second day when the market closes down with volume picking up. Around the second or third day, you start to get suspicious.
Sample complete. Ready to continue?